Hello, I'm Burhan Khadbai, Head of Content at OMFIF Sovereign Debt Institute, and today we're looking at the European government bond market. I'm delighted to be joined by James Athey, Investment Director at Abrdn. James, thank you for joining me first. How does this year compare to previous years for European government bonds? It's been quite a year, and there's still a few months left.
Yeah, morning, Burhan. That's an understatement, I think. There's a there's a heck of a lot going on in government bond space. Obviously, the last 2 years, really, the global economy and financial markets have been hit with consecutive shocks, significant, global in nature, and very difficult for policymakers to deal with. One of the most obvious outcomes from all of that turmoil has been the inflation situation that we now all face. High and rising inflation, predominantly coming via commodity prices and input costs, but latterly flowing through the economy in a way which suggests, unchecked, that inflation could become a problem. And obviously, for a fixed income investor, inflation really is the enemy. So central banks having to push back aggressively against inflation from a starting point of monetary policy being as easy as it has ever been in history really is a dramatic turnaround. So government bonds are a very unloved asset class at the minute.
So how are you managing your portfolio for government bonds? With inflation rising, you're saying it's the enemy for inflation is the enemy for bonds. So how are you managing your portfolio for bonds?
Yeah, I mean, it's as we sit here today, it's probably even more difficult because there's so much in the price. We've seen significant steps to tighten monetary policy across almost all of the world's central banks. That includes the ECB. If you'd have asked me 2 years ago, I'd have said the ECB could almost not get away from negative rates under any conditions. And here we are, they're hiking by 75 basis points at a time. In terms of what that means for the portfolio, the most obvious starting point is being underweight duration, which we have been for some time. In European space, because of the divergence across the various sovereign markets which make up the monetary union, there are quote unquote winners and losers. There are certainly sovereigns which are more vulnerable. Italy is primary there. And so, we have retained an underweight position in Italy almost throughout this period, because monetary tightening or monetary support has really been the only thing preventing Italian yields from being priced more appropriately by markets.
Yeah, but we'll talk about the Italy situation in a bit. But on the flip side, are European government bonds more attractive in a sense because of the higher rates?
On the face of it, of course, it's much more attractive to buy something yielding 2 or 3% than it is to buy something yielding 0 or even negative. But of course, being early into a position is akin to being wrong. So buying when those forces which pushed yields higher are still very much in the market's mind can lead to sort of interim losses. So at a global level, we have been happy to add duration, but we just think that there are economies which are further advanced in this process of monetary tightening when compared to the ECB. So we retain an underweight in Europe. We don't think yet is the time to be buying duration there, but we have been happy to add duration in the US and some of the other dollar block markets and actually emerging market local.
Yeah, and you mentioned the aggressive monetary tightening. I guess the question in everyone's mind is when the ECB will start QT. They've mentioned, when rates normalize. There's been lots of suggestions of timeframes. Do you think what's your sort of take on when they may start QT? And I guess it's quite important for them to sort of time it quite right.
That, I think, is a really difficult policy for the ECB to enact. We can see, just looking at the gilt market over the last few weeks, the potential challenges. The Bank of England hasn't even begun its quantitative tightening process, and before they've even got there, they've had to instigate a kind of emergency asset purchase program to prevent market dysfunction. Now, in Europe, they've already pre-announced such a program, the so-called transmission and protection instrument. There are some details around that program and how it would be activated and conditions that would need to be met. but really investors, I don't think, fully comprehend when and how that might come to pass. But of course, it does look very strange to have central banks essentially buying and selling assets at the same time. So I don't think the ECB really wants to get there. I think the ECB's hope would be that rate hikes, and potentially significant rate hikes, are sufficient to cap demand in the region, just prevent the second and third round effects of inflation really taking hold. And as we move through 2023, inflation should come down just via lower commodity prices, base effects, and essentially the squeeze on real incomes, leading to demand destruction and loss of discretionary consumption power. If they were to get to the stage of quantitative tightening, I don't think we'd be looking until probably the middle of next year at the earliest.
Yeah, once there's been a few more rate hikes, potentially. And you mentioned TPI, and I guess that's another interesting, and like you say, quite puzzling instrument. No one quite knows how they're going to use it, when they're going to use it, but it looks inevitable that they will use it. But what's your understanding, or what's your sort of thinking that how they may use this? Is there a particular, for example, a BTP's bund spread target they'll look for, or how else could they sort of potentially sort of trigger this?
Yeah, I mean, it's clearly not an instrument designed specifically to deal with challenges in the Italian bond market, but the reality is that just because of Italy's debt and growth dynamics, very high debt to GDP, 150% or more, and very low potential growth, and therefore really restricted ability to grow their way out of their debt problems, that makes the Italian bond market generally the weakest link in the monetary union chain. And so it seems likely that if TPI is activated, it would be because of some dysfunction in the Italian market. Now, the triggers for them activating it, again, not truly known, but I think it's more likely to be evidence of market dysfunction. So illiquidity and rapidity of moves higher in yield and wider in spreads, rather than a particular level. Although obviously the level at which they first were to announce or first to begin buying bonds under that program, markets would immediately hone in on as a line in the sand, even if that was not the ECB's intention. But there are other conditions around debt sustainability and oversight from within other European bodies, which seem to be part of the criteria necessary. So as is often the case in European monetary policy space, there is a political element to the program as well, which may make it more difficult to activate, except in extreme circumstances.
Yeah, and you mentioned Italy poses perhaps one of the more delicate situations in the periphery, and I guess the ECB has got to strike a fine balance with starting QT. Obviously, Italy's got a new government, and we're not sure how that's going to look fiscally. Potentially higher borrowing program next year that could be quite substantial. So there's all these parts to things that could affect the B2B market. So I guess it's important for ECB to strike a fine balance. But I guess there's TPI, and I guess is that enough firepower for them to sort of support BTPs?
I mean, it's difficult to argue that the ECB doesn't have sufficient firepower, just because on the face of it, there are some limitations to these bond buying programs. But as we have seen in a number of instances in recent periods of stress, there seem to be ways for European institutions and bodies to circumnavigate some of these supposedly hard and fast rules. And so I think a lot of investors would suggest that the ECB has essentially unlimited firepower, where legally its mandate is to ensure price stability. The unwritten rule seems to now be that the ECB is tasked with keeping the union together at all costs by suppressing bond market forces where they could become self-fulfilling and damaging. So I certainly wouldn't want to take on the ECB as an investor if we get to the stage where TPI has been activated.
Yeah. Just on QT again, I mean, how would you sort of describe the potential impact of QT on yields in terms of, I guess, bunds and I guess peripheries and peripheries spreads as well?
Yeah, I mean, it kind of depends on the form it takes. The Bank of England is attempting to really engage in active sales The Federal Reserve has gone for a more passive approach where it simply allows bonds to mature from its balance sheet and doesn't reinvest the proceeds. Those two dynamics are very different in terms of how they would impact bond markets. In the Fed's case, the impact really comes via the supply profile, because that's how the relationship between the Treasury, who issue federal debt, and the Federal Reserve, who've been buying it, really comes via the auction schedule. And so if the Treasury continues with its current issuance strategy, that's roughly an average maturity of 5 or 6 years. That's maybe where you'd expect to see a bigger impact on yields. The Bank of England has a longer maturity profile. The UK DMO, the Debt Management Offices, likewise, and therefore you might expect to see a bigger impact at the long end. In Europe, there are further degrees of freedom because obviously they have bonds from a number of different countries. So it would depend on the specifics. If it was a more passive program, just allowing bonds to mature and not be reinvested, it shouldn't be hugely impactful on yields across the curve. Although I think from a sentiment perspective, from a signaling perspective, we would definitely expect to see spreads between the likes of Italy and Spain widen versus Germany, and that would probably happen across the curve.
Yeah, okay. Yeah, I guess it's something you've touched on as well. I mean, I guess the situation in the UK, what the government has done with its fiscal package, I guess that's a warning sign for other European nations that could come to this sort of similar situation dealing with the energy crisis.
I mean, it should be a warning sign. The warning signs have been there for a while. If we go back to the last great inflationary period that really began in the late 60s, but it was exacerbated through the 70s in a similar fashion to this recent episode by supply shocks and commodity price rises. The mistakes which were made were essentially that governments were too loose in their fiscal stance and central banks were too quick to ease off their monetary tightening, and that allowed inflation to rise again. On the monetary side, that's an open question. We haven't got to that point yet. But on the fiscal side, we are seeing governments essentially push more money into an economy which is already running above capacity. And that is, just on the face of it, in very basic economic terms, that is inflationary. So they are feeding the very problem that they're trying to resolve. But the politics dictate that when you have significant percentages of the population who really are going to face hardship as a result of rising energy costs and rising food costs, some of these economic arguments which might play out 1, 2, or 3 years hence really get pushed aside and the politics dominate. And I kind of think that that's likely to be the case. And the central banks then become reactive, and they are essentially forced to intervene in markets in order to try and offset some of these bond market forces, which otherwise could become more pernicious and more damaging. All of this is understandable. Personally, I am rather concerned about the medium-term impact because, this really is a situation of moral hazard. Once you give market participants an indication that there is a backstop, that there is a body or a force that will essentially get them out of trouble if they overextend, then that merely encourages the sort of leveraged behavior which can create these market disruptions in the first place.
Yeah, that's really interesting. And just a question about moving on slightly to a slightly different topic, but related. To deal with the energy crisis, there's been talk of a sort of joint debt scheme by the EU, similar to what the EU has done with the Shore during the pandemic. What's your sort of take on that? What's your thoughts on that? Is that a possible? How likely is that? And do you see that coming to fruition?
I mean, just in the last 24 hours, we've had headline and counter headline. There was a story yesterday suggesting that German Chancellor Olaf Scholz was open to the idea. There was then fairly shortly afterwards some pushback from a German government official saying that wasn't part of the current plan. I'm tempted to say where there's smoke, there's fire. Obviously, joint issuance has been a bit of a taboo, certainly in Northern Europe, but the extent of the pandemic economic emergency was sufficient to push governments across Europe over the line. The interesting thing is that those original programs, Shore and NGEU, there are still significant resources which have not been drawn down that are available to be loaned to European governments. Therefore, on the face of it, it should be relatively easy to agree a repurposing of some of those funds. Those funds really have been set aside for the energy transition. And while investment in energy production would be a great solution to some of these energy cost problems in the long term, they won't really deal with the economic problems in the short term. It shouldn't be too difficult for European governments, I don't think, to agree to repurpose some of those funds. So I don't think we should be near to a point where new EU issuance is required. But just the optics within Europe and the desire to act as one during good times, but the reality of acting unilaterally during bad times has played out recently, where the likes of Germany and Netherlands have announced huge support programs for their domestic economy in the sort of size that the more indebted and weaker nations are just not simply able to engage in, because bond markets would revolt. And I think that does not look right or reflect well on the European Union and its cohesion. And so I think if we don't see, problems resolving themselves in the relatively near future, I do think that conversation will come to the fore, and we could well see a repurposing of those NGEU funds.
And in terms of the impact of that potential, new joint debt vehicle for the energy crisis, the impact on the market would be, more inflation, and I guess it would speed up more rate hikes.
Yeah, I mean, it's on the face of it, that makes sense. The interesting thing is how some of these programs have been structured to actually cap inflation. You face a choice, the choice between a blanket policy, which essentially caps the price of electricity or wholesale electricity or gas, or some link in the chain that leads to energy prices for consumers. You cap the price, and in doing so, actually, you cap inflation, and that takes away some of the pressure on central banks to hike. But it also means that you reduce the incentive to be more efficient in energy use, which is obviously a negative, but you also are giving resources across the spectrum to those who are in need, but equally to those who very much are not in need at the upper end of the income spectrum. That, therefore, is one of the challenges when constructing these policies. But if they are constructed like that across the European Union, and we see, therefore, inflation and inflation expectations for 2023 significantly lower because prices have been in some way artificially capped, potentially that could take away some of the pressure on the ECB. Whether or not that leads to a sort of secondary inflation peak will at least partly depend on consumer behavior and the extent to which those additional resources that have been provided are just spent on electricity and or saved versus spent on discretionary items. So there's a lot of unknowns there. How the program is structured will first and foremost dictate how we would respond to it.
Okay. And how do you view the EU as an issuer? I guess there's debate about whether it's treated as a sovereign, a supra, a safe asset, a rival to the Bund. How do you sort of view the EU since the arrival of the EU as a sort of big and frequent issuer?
Yeah, I mean, the way that we've initially viewed it really is that it's more akin to semi-core rather than being equivalent to the Bund. But it really carries a kind of implied higher credit rating versus semi-core nations, and a higher spread in some cases. So it looks to us actually relatively attractive as an investment on the face of it, because its implied credit rating is higher than the likes of France, and you pick up a bit of spread. How such debt performs in recent episodes, what you see is that there is still a liquidity premium. They're not super liquid issues, and therefore you can see some spread widening and some pressure on them just because of technical drivers. And so that's very much something to be aware of if you are investing in those markets.
Okay, great. Thanks, James. Is there anything else you wanted to discuss? Or
yeah, I mean, I guess we haven't talked about the economy up above and beyond inflation, right? Because that's the other aspect of this.
Yeah.
The situation that we face is very much one of high inflation, but not high inflation driven by excess demand per se, but by restricted supply. And it's very much inflation which is concentrated in non-discretionary consumption items, food and energy, and the secondary impacts on some of those. it is in and of itself demand destructive. This inflation should sow the seeds of its own demise. When you then throw into the mix a global coordinated monetary tightening, the likes of which we haven't seen in 30 or 40 years, there is the potential for some particularly negative growth outcomes as we move through the end of this year and into next year. And on the face of it, that should be supportive for government bonds. Dealing with that challenge of high inflation and very weak growth, the sort of stagflation for bond investors is a nightmare we've not had to face for 40 years. But we do think that as we move through the next 6 months, the importance, the relative weight, if you like, of those two drivers should shift more towards the negative growth impact. And so we're not in the camp where we think yields are going to sort of continue to spiral ever higher beyond the economy. The other reason we don't believe that's the case is because the financial system is still somewhat fragile. There is still a lot of leverage inherent across economies and across the financial sector. That's really the main reason we've seen such a dramatic move in gilts, is because liability-driven investors were using a lot of leverage, and it's leverage which tends to cause these sorts of problems. Unlike 2008, the leverage really isn't in the banking system, but it is in corporations, it is in consumers, and it is in the financial sector. And so we suspect that there are going to be ongoing risks of sort of economic and financial accidents while we complete this monetary tightening process.
Yeah, thanks, James. Appreciate your time.
Good to see you.
Catch up soon.